Well, capital outflows can become a big problem when they reduce domestic liquidity, and in the case of fully-fledged capital flight, foster a sharp depreciation in the currency. This is the MoneyMakers. I'm Bruce Whitfield. Tonight we follow where nearly $100 billion, which has left China in the first 3 weeks of August, and try to follow where the money is going. I'm joined by Nerina Visser, who's an ETF strategist and advisor, Mohammed Nalla, who's the head of strategic research at Nedbank Capital, and in Seattle, the chief economist at Evergreen GaveKal, Wray, joining us via Skype. We had you on about a month ago, Worth, and you were Papa Bear Supreme. You were warning us that the world was about to become unstuck, and it did. So, great guru, what happens in the next month?
You know, I'm afraid that's a question of what happens with China and what happens with the Federal Reserve. Unfortunately, in the next month, there are a number of catalysts that could take a turn for the worse in both cases. And I think Stan Fisher did something at Jackson Hole that I think is still underappreciated. Last year, Janet Yellen gave a speech that people said didn't really matter, but she redefined the Fed's full employment mandate, what they were looking for in order to tighten, in order to hike. And this past weekend, Stan Fisher did that exact same thing with inflation. He redefined the mandate. He explained that they do not need inflation at 2% in order to move forward with a hike. And I think he put September back on the table. A Fed hike would be extremely destabilizing, especially in light of China's new renminbi fixing structure, the way that they set the renminbi exchange rate. Now that the renminbi can be more market-driven within a 2% band of trading every day, you can now see in the wake of a Fed hike, if Chinese outflows accelerate, the renminbi can fall 2% a day for many, many days in a row. It could set up quite a deflationary shock, which is not a good thing for emerging markets.
Okay, Worth, he is in Seattle. Mohammed Nalla is in studio with me. How does this play out for South Africa? Because we've seen the consequence in recent weeks of the Chinese currency devaluation. First, we saw a big run in markets. The JSE has come back really strongly. I think August we were probably flat month on month, but our currency is where the weakness has played out and has remained.
Yes, I mean, Bruce, that's really how you've got to look at it, because an international investor is going to look at the top 40 and then he's going to look at it in dollar terms, and that's effectively his real return. I've been saying for quite some time, I mean, whether it's the Fed, whether it's China, these are just catalysts for an underlying weakness that has been pervasive throughout emerging markets for some time. I mean, they've effectively squandered the honeymoon phase, if you want to call it that, of rampant commodity markets, easy capital flows. And now, unfortunately, you know, those things don't last forever. So we're potentially faced with the reversal thereof. And unfortunately, it has pretty dire ramifications for the likes of South Africa, which I would categorize as an emerging market where our fundamentals do look quite stretched. Now, on the back of that, is it irreversible? Do we have to consign ourselves to the do not go here bucket? I don't think so. But the fact of the matter is that emerging markets are going to come under pain, and the ones that eventually start shining through, and I say eventually because these cycles run anywhere between 5 to 10 years, the ones that eventually shine through will be the ones that are proactive on the reform side, put in place proper structural reforms, and actually just get their houses in order.
But you are a cynic about South Africa's political willingness to do that, because that requires some quite severe trade-offs.
Well, we're halfway there, and I'll tell you what I mean when I say we're halfway there, is that we're saying the right things in many respects. And if you just cast your eye over the NDP, it's got a lot of the key building blocks that we require to be very investor friendly and to effectively get our growth rate up to where we need it to be. We fall flat on the implementation. That's where you hinge on a very important component, which is the political will to do so. We've got this very funny political setup where we've got, very disparate policies within a ruling coalition, if you want to call it that, and some of them are pro-market and some of them are very anti-market. And so that unfortunately represents a little bit of a hurdle in terms of getting us across the line when it comes to implementing market-friendly policies.
Now, Mohammed Nalla, Nerina Visser and Wray are very negative people. They are harbingers of doom and gloom. Worth, sitting in Seattle, is saying that the next month is make or break for the world. Correct me if I'm wrong on this one, Worth. But he's really concerned about what's going to happen to the Chinese currency. He's really concerned about the US Fed. I would have thought by now, markets being clever forward pricing mechanism makers, that they would have worked all this out for themselves?
Will certainly not work it out for themselves, but I do think that a lot of what we can expect to happen in September has been priced in. In particular, I think the first interest rate increase in the US has been priced in. Whether it happens in September or in October or in December will not really make all that much of a difference. I do believe it's been priced in. And there you might actually find, you know, almost a typical sell on rumor, buy on fact type of scenario in September. For me, when I look at China, I acknowledge that China is not this homogenous animal that we would like to make it out.
It's a bit like the ANC.
Yeah, I'm not sure who's got more heads there, but certainly it's got two currencies for starters. Yeah. It's got stock exchanges that are for foreigners or for locals. It's onshore, it's offshore. So all these dynamics that I think when we just say China, it's almost as though we assume that this is a singular issue, and I don't believe that it is. So I think there are certainly areas and pockets within China that I think is going to be absolutely fine. A lot of the uncertainty and the volatility that we're experiencing at the moment, I think, is part and parcel of a restructuring economy, and one should expect this type of volatility. I am a lot more concerned about the emerging markets that, and not just emerging, Australia is a developed market, but the markets that actually exported to China and the impact that what is restructuring in China is happening in its economy, how it's going to affect those other markets.
Worth in Seattle, give us a sense of it, please, in terms of China's ability to keep growing and keep consuming, because there is a great deal of skepticism as to whether or not the Chinese have left this restructuring of their economy just a little bit late.
Absolutely. It's getting a lot harder, and I think the medium-term risks are rising. Look, this is something that I've been talking about for a very long time. You know, along with a number of China watchers, I pointed out that and said that their growth model could not last much longer. Their growth, which is largely driven by investment demand that's fueled by unsustainable credit, had to make a transition. The economy no longer could be driven by, you know, investment in real estate, infrastructure, things like mining. It had to transition to a new economy driven by retail, services, technology, moving up the value chain in manufacturing. But that would not be an easy transition. It would require embracing a great amount of pain and moving through an embarrassing time for Beijing, where they'd have to admit that growth rates were not as high and they would have to push through. Unfortunately, Beijing has tried to have its cake and eat it too. Instead of making hard decisions, it blew an enormous equity bubble trying to attract foreign capital in. The plan was to deleverage troubled companies and offload bad assets onto foreign investors. That way, China didn't have to slow down, but it could make the transition more easily. It has failed miserably and backfired as the stock market has come crashing down, and I'm afraid Beijing's credibility with it. Now, there is one very important point I want to make about China right now, is that its economy is not collapsing. Despite what you may have seen with the Purchasing Managers Index, the PMI overnight, that's actually a very poor indicator of China's economic health over time. I'm seeing very few signs that China's economy is collapsing. So this is largely a sentiment and a credibility thing around Beijing. It certainly has an effect. I'm more worried about China over the coming 6 months, over the next year, and the direction that it could go, especially against the backdrop of weak global liquidity. I think this is more a story of what's happening with countries that are impacted by China, impacted by the Fed, and I don't think either of those things are fully priced.
Okay, I mean, that's an interesting perspective. I mean, are we headed, as some people might suggest, into a global recession? China, the slowdown may not be as pronounced, but certainly China is growing more slowly than previously. The US is fine. Europe is showing signs of life. Britain is showing signs of life. But it's a tentative, quite prickly recovery.
Bruce, it's been a tentative, prickly recovery for a very long time.
Are we at the end of that recovery phase and headed into a recession?
I would say no. I think, you know, calls of a global recession are certainly premature, certainly at this stage. And I'll tell you exactly why I say that, is that you've got easy monetary policy in the Eurozone, and they're starting to stabilize and tick a little bit higher. So that's one thumbs up. You've got China. Yes, it's slowing, but hey, it's still at 7%. And if that slows to 6%, it's not a catastrophe.
If you believe the numbers.
If you believe the numbers. But the fact of the matter, it's the world's second largest economy. If you take the number down from 7 to even 5%, that's still a massive. There's a number. I mean, last year's nominal growth in China was larger than the entire economy of Switzerland. So let's put that into perspective. And then if you have a look at the US, I mean, they just revised their GDP numbers, if you believe the numbers. They just revised their GDP numbers substantially higher. So I think calls for a global recession at this stage, certainly premature. The teething pains are going to be there. And like I say, how I would position is I believe emerging markets are a bit on the back foot, and so when you go through these teething problems, emerging markets are going to carry much more of the pain.
Okay, Nielsen came out with some research and said South Africans, 73% of us or something, believe we're actually already in recession in this country based on the second quarter GDP numbers, which were surprisingly negative, and just the sentiment in South Africa. PMI numbers in South Africa below 50, the Barclays PMI now, below 50, suggesting contraction in manufacturing. We've got conflicting policy that Mohammed points out here, Nerina. Are we actually in recession right now?
I'm part of the 73%. Yes, I do believe that South Africa is already in recession in the way that GDP is being measured at the moment. And I think that's quite important. Once again, there are areas, we know them very well, certainly mining, manufacturing, and even agriculture is really deep in recession. But then there are also areas of excellence and pockets of excellence. And it's about, can we, just like China is readjusting and realigning their economy, can we also change the makeup of our economy and stop being so backward looking and always rely on what drove our economy 10, 20, 50 years ago, and actually start focusing on a 21st century economy. It comes back to the question of political will. You know, we've got a municipal elections coming up in 2016, and I think unfortunately the talk will continue to be populist. So that's where I don't have the faith in the near term for South Africa for a change.
You think quarter three will come out in the red? 2 quarters of contraction is recession?
No.
Mohammed Yaseen, he's a banker. He's part of the 1%, you see. No. She's part of the 73, and you're part of the 1%. Why are we not in recession?
First and foremost, so recession, technically you've had 2 consecutive quarters of negative growth. The low base you set in the second quarter, I think, would actually, ironically, give you a higher probability of getting a positive number in Q3. However, it doesn't mean the risk of us going into a recession in 2016 has disappeared completely. So we're not yet there. The direction is very worrying, and we might get there. I hope the SARB's listening, because if they hike too aggressively, they will push this economy into a recession. I'm worried about next year.
Worth W. Wray in Seattle, let's wrap with you. I mean, from where you sit in the behemoth of the United States of America, the most powerful economy in the world once again, it always has been. Give us a perspective from there about what you see in little old South Africa.
Well, I have to agree with Mohammed in terms of where we are in global growth. What I'm concerned about is that the United States is a lot stronger than the rest of the world, particularly emerging markets. And I think we are setting up for quite a dollar rally in the coming months. That's going to be nasty against the backdrop of slowing Chinese growth, slowing Chinese investment demand. The downside for commodity prices is substantial, and the downside for dollar debtors is quite high. In South Africa, you have an interesting dynamic. Your economy hasn't benefited so much. It hasn't gone gangbusters or had a credit miracle as a result of all the capital inflows since 2008. In fact, South Africa has just avoided capital flight because your fundamentals have been quite ugly. I certainly think you're headed into a recession now. And I think South Africa is one of the prime candidates in the world for a real FX crisis if both commodity prices fall and capital outflows reverse. You have very deep liquid markets, and it's certainly going in that direction. The good news, if you want to look at a silver lining, is that you're not alone. A lot of emerging markets will be in this boat. Countries like South Africa will pull a lot of other more stable countries into the contagion over time. And I think that in the recovery phase, we will see a broad-based emerging markets recovery. I think you will see inflation in the world, and commodity prices could do quite well. So this does not last forever, but a little more darkness before the dawn.
There we go. Worth W. Wray, if I could reach into your screen, I would punch you on the nose. You're not alone. It doesn't help. But Worth W. Wray, thank you so much for your perspectives this evening from Seattle. Chief Economist at Evergreen GaveKal, Worth W. Wray. Thank you for taking time out of your busy schedule to join us. Nerina Visser, ETF strategist, optimist but concerned about South Africa going to recession. And for once, Mohammed Nalla being positive. Q3 won't be in recessionary territory. Well, Q4 will tell us, I suspect. Mohammed Nalla is Head of Strategic Research at Nedbank Capital. We'll tell you what else is going on tomorrow if we survive long enough till then. Bye-bye.